The US consumer is losing confidence. Inflation fears are back. And the latest data shows that optimism about the economy has crashed to its lowest levels in years. But why are people so worried when spending still looks so strong? The American consumer is worried again. Consumer sentiment has collapsed, dropping to its lowest levels in years. Why, you may ask? Because inflation fears are back. And they're hitting households right where it hurts: the grocery store, the rent check, and the gas pump. But here is the paradox. People are saying they're pessimistic about the economy, yet they are still spending. Retail sales are holding up, credit cards are still being swiped, vacations are still being booked. So, what explains this strange disconnect? And what does it mean for the US economy in 2025? In this episode, we are going to unpack it all. What consumer sentiment actually measures, why inflation is haunting households again, the gap between what people say and what they do, how politics and policy are shaping confidence, and finally, what this means for businesses, the Federal Reserve, and, most importantly, for all of us. Consumer sentiment is not just a mood swing. It is a powerful economic indicator indeed. The University of Michigan's Consumer Sentiment Index has been published since the 1940s. Economists use it to gauge how people feel about their current financial situation and about their expectations for the future. When confidence rises, people spend more freely. They buy cars, they buy vacations, they invest in their homes. However, when confidence falls, people tend to hold back. They cut expenses, delay big purchases, and increase savings just in case. In fact, consumer sentiment has been a leading indicator of recessions. Drops in confidence frequently happen before downturns. Why? Because spending is 70% of the US economy. This means that if households get cautious, the entire system slows down. So, when the index fell sharply this past month to 58.6, well below what the economists expected, it set off alarm bells. So, the question that matters now is, what is driving this pessimism? The short answer? Inflation. Producer prices in July jumped at the fastest pace since 2022. This means higher costs are making their way through the supply chain and will soon hit consumers. Households are already feeling it. Grocery bills that were finally stabilizing are ticking back up. Rent increases are rolling in, especially in big cities. Healthcare and insurance costs are climbing again. Even if wages are rising, inflation acts like a silent tax. It erodes the purchasing power. This means your paycheck may be bigger in nominal terms, but it doesn't stretch as far. And here is the key. Inflation is not just about math, it's about psychology. When people feel prices are rising faster than their income, they feel poor, regardless of what the data says. That sense of financial squeeze is fueling the sentiment decline. And now, here's the fascinating twist. While surveys say confidence has dropped, actual behavior tells us a different story. Retail sales in July came in stronger than it was expected. Restaurants, airlines, and retailers are reporting steady demand. Economists call this the expectations gap. People say they're pessimistic, but they keep spending. So why does this happen? Sometimes habits and commitments override the sentiment. Families may still take summer vacation even if they worry about money. Credit access matters too. Americans are leaning on credit cards and personal loans to sustain spending. And, in some cases, people may exaggerate pessimism when asked in surveys, especially if politics are shaping their outlook. But here is the risk. If confidence stays low for long enough, behavior eventually follows. Pessimism has a way of becoming self-fulfilling. People tighten their belts, and suddenly the slowdown that everyone feared starts to materialize. Another factor weighing on sentiment: political uncertainty. Households are being bombarded with debates about tariffs, government spending, and the Federal Reserve policy. Tariffs, in particular, raise fears about higher consumer prices. Fed decisions create anxiety about mortgages and credit card interest rates. And let's not forget the political narrative around inflation. For some, inflation is blamed on government overspending. For others, it's tied to immigration or global conflicts. In reality, the drivers are complex. Supply chain disruptions, community markets, and consumer demand all play their own role. But perception matters, and matters a lot. If political leaders tell people the economy is broken, sentiment surveys will reflect that sort of pessimism. This is why sentiment is not only about economics. It's about trust in leadership and trust in institutions. It is important to highlight that the US is not an island in this story. Around the whole world, households are facing similar pressures. In Europe, for instance, consumer confidence is falling as energy prices remain volatile. In Asia, rising food costs are eating household budgets. Latin America is grappling with currency depreciation and higher import costs. This shows that inflation's impact on confidence is quite universal. Even modest price increases can undermine optimism when people feel the future is uncertain. The global nature of this challenge also complicates the solution. If inflation pressures are worldwide, the Fed alone will not be able to solve them. For businesses, consumer sentiment is not just an abstract number. It is a warning light on their dashboard. If confidence falls, big-ticket spending is usually the first to go. Car sales slow, housing demand dips. Travel plans get postponed. Retailers find themselves with too much inventory. Companies reliant on discretionary spending, like restaurants, entertainment, luxury goods, see the impact first. Investors know this, which is why they watch sentiment surveys very closely. If falling confidence turns into falling sales, corporate earnings will take a hit. Already, some analysts are warning that the holiday season could disappoint if sentiment does not rebound. So, where does this leave the Federal Reserve? In a very tricky position. On one hand, falling consumer confidence suggests the economy may be slowing. That could argue for cutting interest rates to support growth. On the other hand, inflation data shows price pressures are eating up again. Cutting rates too soon could make the problem even worse. This is the classic policy dilemma: fight inflation or protect growth. Doing both is nearly impossible. Some fear the US could slide towards stagflation, low confidence and sluggish growth combined with stubborn inflation. That's the nightmare scenario for policymakers. The Fed will be weighting the data carefully, but markets know one thing: whatever the Fed decides will ripple through mortgages, credit cards, and of course business loans. So, where do we go from here, you might ask? If inflation stabilizes in the coming months, confidence could bounce back quickly. Households may breathe a sigh of relief, and businesses could see demand hold steady. However, if prices keep surprising to the upside, pessimism may deepen, and this time it could finally catch up with spending. Consumer sentiment may feel like a soft statistic, but it shapes hard realities. It tells us how households are feeling, what businesses might expect, and how policymakers will react. The big question now is, will this be a short-lived dip in confidence or the start of something more serious? What do you think? Is the consumer just nervous, or is the US economy heading towards a slowdown? Let me know your thoughts in the comments, and do not forget to subscribe for more insights on the economy, inflation, and global markets.